Okay guys, and what I want to do in this video is continuing on with our study of national income and macroeconomics, and then make the distinction between two measures of national income. So there's many different ways of measuring national income, and some have benefits over others, or it just depends on what you're looking for. But what we're going to look at is two separate and different ways of measuring national income and the reasons for the difference, and therefore I suppose some of the benefits and costs of using one versus the other. There is no one overriding best measurement of national income. Each of them have their benefits and each of them have their drawbacks. Okay, so the two that we're going to be looking at today is gross domestic product and gross national income. All right, and as I was saying, they are just different ways of measuring how well off a country is. Okay, so what we're saying is that if you look at this graph, all right, and this is for the Irish economy, they tend to move in the same direction. Now, if they tend to move in the same direction, you might be, I suppose, you may ask the question, well, what's the point in the difference? And there are subtle points in the difference, but right now what we're going to do is have a quick look through how to calculate or how to get from one to the other, and then we'll talk about, give a few mathematical examples about how to measure them, and I suppose why we choose this distinction. So to get from what's called gross domestic product, now up until this point in all these series of videos on Unit 3.1, what we have done is we have been calculating gross domestic product. It is price times quantity plus price times quantity plus price times quantity all the way through. And now what we're looking at is how to get from gross domestic product down to gross national income. And what we say is we either add or subtract this thing called NFIA. We either add or subtract net factor income from abroad. So there's a few things that we need to look at in order to understand the distinctions between gross domestic product and gross national income. I would argue the very first thing that we should look at are the definitions of each of them. All right, so all I'm just, follow on. I know what's written on the screen, but follow on from what I'm saying here. Gross domestic product is the total value of all goods and services produced in Ireland. All right, that's what I want you to think. So close your eyes. Gross domestic product is the total value of all goods and services produced in Ireland. And of course, as with every single video, insert your country's name here. Okay, so it's the total value of all goods and services produced in England, France, America, China, Russia, Korea, wherever. Okay, gross national income is the total value of all goods and services produced by Irish people. And that's the distinction. One of them, gross domestic product, is in a geographical location, all right, produced within the borders of Ireland. And gross national income is about the nationality of who owns those factors of production. Okay, so kind of what's the difference? Well, I feel that I've said the difference, but I shall give a more in-depth analyses. Now, what I want you to understand is we're talking about production as always, but now we are making a distinction. What are the things that produce goods and services? Well, they are the factors of production. They are those resources that are used to produce goods and services. But now we are talking about who owns those factors of production and where did they make the stuff. Okay, so I've said that, yeah, so you just either add or subtract net factor income from abroad. So now what I'm going to do is, right, I am going to talk about the owners of factors of production, and this one is land. Okay, so this is an actor called Cillian Murphy. All right, you may know of him through the Netflix series Peaky Blinders or like Batman and all that kind of stuff. He's an Irish actor. Let us assume, okay, that what does he do? He buys a house in England. And he doesn't buy to live in it, but he buys a house in England and he rents that house out. Okay, like to tenants, right? So he's not living in it. It's kind of an investment if you want to look at it in the colloquial sense, all right? But he owns land in England, okay, and he rents that out. Now, he's providing a service, he's providing rental property for somebody in England. That payment that he receives is part of English GDP, gross domestic product, because that was a service that was produced in England. However, the money that he sends back home, okay, all of that is part of Irish GNI, gross national income. Now, forgive me, sometimes I will say GNP, and you'll see the IB make these distinctions as well. You can either call it gross national income or gross national product. So any money that is earned from the renting of that land, it doesn't even have to be a house, it could be a field, right? That's part of English GDP, gross domestic product, because it's the value of goods and services produced in England. But any money that he sends home from that, well, he's an Irish-owned. He owns that factors of production. That land that he owns is an Irish-owned factor of production. So any money that he sends back to Ireland from that, that's part of Irish GNI. So GDP is within the geographical boundaries of England, and GNI is what is the nationality of the person that owns that factor of production. Okay, so I'll say it again and I'll go through quicker as we go. Cillian Murphy, an Irish actor, he buys, it doesn't even have to be a house, guys, it could just be land, and he rents it out to a farmer. And the money that he gets from that is part of English GDP, because that's the value of goods and services produced within England. But any money that he sends back to Ireland is part of Irish GNI, because that is a payment received for the ownership of an Irish-owned factor of production. Now, again, this is Daniel Radcliffe. I don't know where I got the ideas from. Let's assume he's English, okay? Let's assume he also buys some land in Ireland. Surprising how closely related these houses seem to be, right? So and he rents it out. Any money that Daniel Radcliffe, the English actor, gets from owning land in Ireland, well, that's a service that has been produced within Ireland. That is part of Irish GDP, gross domestic product, because it is the value of goods and services produced within Ireland, the boundaries of Ireland. But any money that he may send home as a result of that foreign-owned factor of production, from my point of view, he's English, I'm Irish, so that is part of England's GNI, gross national income. So what we're doing is we are realising that factors of production can work in different countries, as I currently am doing. I'm not in Ireland at the moment. And as such, any money that I send home is part of Irish GNI, okay, gross national income. Now, I suppose, really feed into the stereotype. This is 100% true. The amount of Irish people that I know in Australia is shocking. I would imagine 10% of the entire country's population has been there for an extended period of their lives. Now, they work in Australia. Okay, they earn money in Australia. That is part of Australia's GDP, gross domestic product, the value of goods and services that's produced within Australia. Any money that they send home, and this is home for me here, okay, any money that they send home to Ireland is part of Ireland's GNI. That money that is sent out of Australia is part of the NFIA, the net factor income from abroad, right? It's part of it, but we'll come to that again. So that would reduce the Australian GNI, but I don't want to confuse you too much yet. Now, another wonderful addition to the Irish society is that there's a huge number of Brazilian people, not just Brazilian descent, like first generation Brazilians in Ireland. Okay, so they're working in Ireland. They earn money in Ireland. That's part of Ireland's GDP, gross domestic product, the value of goods and services produced within Ireland. I'm trying to say this over and over again so it sticks. Any money that they send back to Brazil is not part of Irish GNI, but part of Brazilian GNI. Okay, so again, all of this I want you to understand, because who owns their labour? Well, they themselves, thankfully, because Ireland doesn't permit slavery, which I 100% agree with. So therefore, they are free as human beings to send their money back that they have earned through the sweat of their own brow back to Brazil or wherever they wish to. But any money that was earned by these Brazilian people working in Ireland, that is, and sent back to Brazil, that is part of Brazilian GNI, okay? Because who owns, they are Brazilian owned factors of production, okay? And I know it's labour, they own their own labour, thankfully. Okay, now we've got capital. Okay, so what I'm going to say for capital, and you know, look, I'm not going to get too much into it, but I just want you to consider money being lent. Okay, we'll just consider that. Okay, so this is actually a photograph of the Bank of Ireland on College Green, and let's just assume that there is an English businessman, okay, and he gets a loan from an Irish bank. Nothing has happened there in terms of net factor income from abroad. Something has happened there in terms of the financial account of the balance of payments, but more on that in a much later unit. Any interest payments received from the Irish bank by its foreign lending is part of Ireland's GNI. Any money that this individual here earns in England is part of English GDP, but because this individual had secured a loan from a foreign bank, any interest payments on the capital is part of Irish GNI. Now, the next thing is we've got an English bank, let's say Barclays or HSBC, and I, of course, chose a red-headed individual to keep with more stereotypes of my own countrymen and countrywomen. So let's assume that there was an Irish business person that borrowed money from an English bank. Okay, nothing has been earned, nothing has been accounted for in terms of NFIA, but when the loan occurs. But any money that this individual generates in his business as a result of production of goods and services, which was funded by this loan, that is part of Irish GDP, gross domestic product. And any interest payments that this individual has to make, not the principal now, but the interest, he will have to make both a principal payment, which is a payment on paying off the amount of the loan, and the interest payment, which is the payment that he has to make in order to secure the loan, in order to is the charge that the bank makes for the loan. So any interest payment that this individual makes above the principal is part of English GNI. Again, we are talking about factors of production. Who owns them? English people, or this English bank, this English company, owned that money. Okay, I'm making that assumption. And therefore they lent it to a foreign person, and therefore that was a factor of production, which was the capital. And as such, I know capital is anything man-made used in the production of goods and services. I'm just trying to keep it simple. Okay, and the final one now, well, we've had land, labour, capital, and the final one is enterprise. Okay, now this is a guy called Richard Branson, and this is actually somewhat of an old example, but it'll work, okay? He set up this company called Virgin Airlines, and they operated out of Ireland, all right, or at least part of it did. Any money that Virgin Airlines earned in Ireland was part of Irish GDP, gross domestic product. Why? Because the total value of all goods and services produced within Ireland. But Irish factors of production, Irish people, Irish households didn't get to keep that. They didn't get to keep all of it, at least. Any of the profit that was repatriated out of Ireland is not part of Irish GNI. It is part of England GNI, or English GNI. There is another individual, this guy called Michael O'Leary. Have you ever heard of Ryanair? They only operate in Europe for the moment anyway. Okay, low-cost airline. They refuse to, it's Irish-owned, they refuse to operate out of Dublin Airport because of the charges that the Dublin Airport Authority were charging them. So they operated out of Stansted in England. Okay, so any money that Ryanair earned from its English operations is part of English GDP, gross domestic product, the total value of goods and services produced within the boundaries of England. But any profit that they repatriated back to Ireland, and I promise you they would, because we have insanely low corporate tax rates, like about 10% or 12.5%, it changes, actually goes back and forth. Any money that they had repatriated out of England and put back into Ireland is not part of English GNI, gross national income, okay? It's part of Irish GNI because Irish people own those factors of production, all right? So what we're trying to do is take into account, yes, it's the total value of all goods and services we produce, that's GDP. It's a great place to start. But if we're going to talk about the standard of living for Irish people, well, surely if Irish people are working abroad or own assets abroad that provide income, well then surely the standard of living from Irish people is not just what is produced within Ireland, but what on net is produced by Irish people. Because let's say I'm Irish and I own a house in France and I rent that out to people and I get money into my Irish account. Well, my standard of living is increased by the ownership of that foreign asset. And I personally would argue that GNI is a better measure of the standard of living of people in a country than GDP, because it takes into account the foreigners who own assets in Ireland, that we as Irish people don't get to keep all of that money, okay, because the profit is repatriated, or the rent is repatriated, or some of the wages are repatriated out to another country. But it also takes into account the amount of assets or factors of production, or whatever you want to put the word you want to put to it, that Irish people own abroad, and then we get money from that, and then we can afford to buy goods and services through that money. Okay, now it's backed up by something real in terms of it's a genuine provision of a good or service, and it makes society better off wherever that is, wherever that asset is. But still, it just shows that if we get money from that, then we can afford to buy more goods and services. Now, so this is telling us the example, and I should have said this is a rather long video. This is explaining to us what net factor income from abroad is. Well, we've said that who earns money? Well, or what, if you want, factors of production, or the owners of factors of production, realizing that you own your own labor. Well, what's going to increase GNI, gross national income? Well, if I have a business and I'm Irish and I own a business in France, any money that I get from that business and I bring back to Ireland, that's going to increase Irish GNI. Okay? Any wages of workers that are working abroad and they send home, that's going to increase Irish GNI. Okay? Any domestic lending from Irish banks to foreign companies that are paying interest back, that's going to increase Irish GNI. Okay? And the rent that was earned by, let's say, the Cillian Murphy example, that he owned a field or whatever in another country and was renting it out to a person in that country, any money that he sends back is also going to increase Irish GNI. So if that was the only story, there was money being sent back by profits, wages, or let's say profits, wages, capital or interest and rent, okay, well then Irish GNI would be bigger than Irish GDP. But that's not the end of the story. And particularly for a small open economy like Ireland, okay, huge number of multinationals. I think directly employed by multinationals are 125,000 Irish people are directly employed by foreign companies. All right, so I mean, there's a massive influx, and we as Irish people benefited hugely from their existence. I know they send money home in terms of profits, but back to their countries of origin. But still, we have massively benefited from their existence, even though we don't get to keep all the money. So another reason why I'd be very much open international trade. So there are Irish companies like Google, Facebook, LinkedIn, Twitter. All of them are set up in Dublin. Every single one of them. They're all providing goods and services. Why are they set up there, as an aside? Insanely low corporation tax rates, insanely low business tax rates of about between 10 and 12.5%, and then they gain access to the European market, whereas other EU countries, 25, 35%. Okay, so that's why they've all set up in Ireland, and also we're English speaking. So any profits earned by LinkedIn, Google, Twitter, Facebook, all these different firms, foreign firms, non-Irish firms that are operating in Ireland, any profit that they send out is going to reduce Irish GNI. Any wages of foreign people working in Ireland. So we benefit from their work. These goods and services wouldn't get produced, and then they get paid for their work, and rightly so. And if they choose as free individuals, which I defend their right to do so, as I defend my right to do so, to send their money to whomever they wish, well then that's going to reduce Irish GNI. If Irish firms have borrowed from Irish banks, okay, I'll have to say it again. If Irish firms have borrowed from foreign banks and are paying back interest, well, I mean, that's a contract that they've entered into as free individuals, assuming that it was voluntary. I believe they should be allowed to do that. And then they also owe that bank not only the principal payments, which is paying off the loan itself, but the charge for the loan, which are the interest payments. Those interest payments that are going out of the country is going to reduce Irish GNI. Okay, and then the rent earned by by foreign landlords in Ireland, any rent that they send out of Ireland is also going to reduce Irish GNI. So guys, what I'm actually going to do now is I'm going to stop the video here. It's going to be a two-part video. I really hope this helps. In the next video, we're going to be calculating net factor income from abroad, and then what we're going to do is get from gross domestic product to gross national income, and from gross national income to gross domestic product. Thank you so much for watching. I really hope this helped, and please stay on and watch the next video.